From a top-down perspective, the coming week is due to be fairly quiet, but watch out for two snippets from the world's biggest economy, America. Both are due out on Tuesday the 7th of July, and both have been covered here before. They are the NFIB Small Business Optimism Survey and the Job Openings and Labour Turnover Survey, or JOLTS. Now, looking at the NFIB, it reached a new high of 108.8 in August 2018, but had begun to gently lose altitude from then on, to suggest all may not have been entirely well with the US economy even before the pandemic. Then came COVID-19, and in April the NFIB showed an understandable lack of optimism among smaller US firms as the reading fell to 90.9, its lowest mark since February 2013. May saw some improvement to 94.4, so let's see what June brings. Economists will be hoping for further gains, as will those investors who have exposure to US equities. There's some suggestion that the trend in the NFIB reading bears some relation to the trend in America's leading small cap index, the Russell 2000, and that in itself is seen to be a pretty good barometer for wider market risk appetite. When it comes to the JOLTS survey, the more job openings there are, then the healthier the US economy should be, at least within reason. Just like the NFIB reading, the JOLTS survey had peaked even before the pandemic at 7.5 million new openings in February 2019. It's been downhill all the way since then, and by April of this year, the number of new job openings had fallen to 5 million, the lowest mark since December 2014. Some signs of stabilisation would be welcome here, as the world's largest economy looks to shake off the virus, but the renewed lockdown in Texas, for example, and fresh outbreaks in Florida, Arizona and others must be watched carefully in this context, indeed as well as other wider ones. Back home on the company front, a good number of large, mid and small cap firms are due to update their shoulders in some way, shape or form. However, do please remember that the regulator, the Financial Conduct Authority, is still giving firms extra time in which to prepare their figures, so these dates are still a little bit provisional. On Tuesday 7th of July, the names in the frame will include Premier Inn owner Whitbread, retailers Halfords and Superdry, and also FTSE 250 tech stock Micro Focus. They'll be followed on the 8th by house builder Barratt Developments and transport firm First Group. And on Thursday the 9th, two more builders, Persimmon and Vistry, will release trading updates alongside Jet2 owner Dart, builders merchant Grafton and MJ Gleeson. However, for me the stock most capable of causing a real fuss in the week ahead is Robert Walters. The recruitment specialist is due to release a second quarter update on Thursday the 9th of July. The FTSE 250 firm's comment should be particularly interesting because of what it does. As a recruitment company, Robert Walters has its finger on the pulse when it comes to the economy wherever it works, which in this case is not just the UK but worldwide. It may not be surprised, therefore, to see the shares have taken a drubbing over the past year, falling by some 40%, even if they're actually up a long, long way from their spring lows. The company's put out two brief updates so far with regard to trading in 2020. Back in very early April, the company announced the cancellation of its proposed final dividend, which left shareholders with just the interim payment of 4.5p a share for 2019. That ended a growth streak in the full-year distribution that had stretched back to 2013. A few days later, Robert Walters then unveiled its customary first quarter update. On a stated and constant currency basis, fee income fell 11% year-on-year. That was worse than the 7% drop in the fourth quarter of last year as COVID-19 began to have an impact. When shareholders and analysts look at the second quarter update, well, they'll be first of all homing on the group-wide numbers when Chief Executive Robert Walters himself predicted a tough 3 months back in April as Europe, the UK and US had just entered lockdown, although Asia was at least just coming out of it. The geographic trends will also be a point of interest in the quarterly update. In the first quarter, Asia was down 5% on a stated basis as Japan, Korea and Vietnam stayed resilient. Workers were returning to offices in China and Taiwan, and Australia and New Zealand had slowed right down at the very end of the quarter. Europe was down 2% year-on-year on a stated basis. In the first quarter, that was still a big slowdown from last year, thanks to France and Spain in particular. And the UK, well, that fell 29%, adding to a dismal trend that had begun as the Brexit deadline and then the December general election drew closer in 2019. Again, watch out for the trends across all of those in the April to June period, as well as the group numbers, with both Robert Walters and also the wider economy in mind. Robert Walters has reacted to the downturn in trading, cutting that dividend, cutting costs by 15% and trimming back executive salaries. Group headcount fell by 2% to 3,935 in the first quarter, and you wouldn't necessarily say that a recruiter cutting jobs is a bullish sign for the future. Also keep an eye on the company's net cash pile, which was a reassuring £110 million at the end of March. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.